What does an angel investor look for in an investment opportunity? Hi everyone, my name is Francesco Perticherari and I'm the co-founder of the Silicon Roundabout Tech Meetup community and managing partner of Silicon Roundabout Ventures, VC firm focused on pre-seed seed startups with high-tech IP. Today, I'm going to try and answer that question by bringing you a recording from a recent online meetup we had at Silicon Roundabout with an actual angel investor, Neil McInerney. And if you want to investigate further on the subject, I'm also going to paste in the description below an article written by a founder from our community that successfully raised angel investment himself. So I hope you enjoy the recording I'm bringing you today. And for any questions, or if you are a startup founder yourself and would like to get in touch, ask for advice and see whether our community and our fund can help you, just reach out. It's easy, free to join the community at www.siliconroundabout.tech. And of course, also you can check us out via email at hello@siliconroundabout.tech. Now, without any further ado, let's enjoy today's recording.
Hello, everyone. I apologize for the slightly delayed start. I'd like to welcome everyone for our event today, which is what, in an angel investor's perspective, what is the ideal investment? Now, I would like to introduce our channel partner, Sam Lucky from Connected, formerly known as Link Exec, to introduce Neil.
Hi there, everyone. Thank you, Rita. Hello, everyone. Yeah, my name's Sam Luckett. I'm one of the co-founders of Connected. Connected is a online platform that helps connect early stage ventures and angel investors and family offices. We thought we'd join forces with the Silicon Roundabout guys to help try and bring some content to the community and try and educate some of the people and try and answer some of the questions that we get asked on a regular basis. So we thought we'd kickstart the new series with a question that we quite often get asked, which is, what does an angel investor look for in an investment opportunity? We're thankful that one of our investors, Neil McInerney, he can join us today. And he's going to answer some Q&A from myself and the Silicon Roundabout guys. I believe Francesco is going to join shortly, and I think he has a few questions. If not, then I can take over. And then, yeah, we'll open up to Q&A from anyone that's listening, and we can go from there. So Neil, I guess over to you. It'd be great to find out a quick bio on yourself and how you got into your professional background, how many years you've been angel investing and that kind of thing. And then we'll sort of run with that, if that's okay.
Yeah, sure. So good afternoon, everybody. As Sam said, I'm Neil McInerney. I am a platform member and investor in Connected. I guess I'd call myself an investor. I've been investing for about 25, 30 years on the listed markets. And then around 5 years ago, where I was working in investment banking, I met a couple of people who were very much into the private equity side. And I looked at that and realized that there's a great opportunity there to get involved in businesses in the early stage, use tax advantages, and really get involved in businesses. So I made a couple of investments there about 5 years ago. And since then, I've invested in about 15 companies, learned a lot of lessons on the way. So by background, I'm an engineer, a qualified accountant, and a serial investment banker. I've been an investment banker for about the last 25 years. So the private equity journey, as I said, started 5 years ago.
And do you feel like the part of the sort of everything you learned in the investment banking world and the accounting thing has led you to be a stronger angel investor in the long term?
Yeah, it certainly has. And in the last 5 years, I really kind of honed the approach to private equity investing. I can run to in a moment what I think, which is the big question for today, which is what is important in selection of a private equity investment. And when I started doing it, you realize it's quite different to the listed market. The listed market's much more transparent and has requirements around reporting and so on. But with the private equity market, there are, there's a lot of upside, but there's also a lot of mistakes you can make. So I'd say what I'm hoping to do today is share a little bit of the journey. There are things I wouldn't do today, which I did do in the past.
I guess that probably leads me on to my first question then, which is sort of the emotional highs and lows of angel investing. Can you share with us sort of some of the highs you might have had, be it successes, or some of the lows you might have had where you've perhaps not listened to gut, or you've had a formula and you've sort of gone against it, and some of the ups and downs you've had along the way?
Yeah, sure. Well, I think a good place to start would be if I just tell our audience here what I think what the criteria I'm looking for in a private equity investment, and then I can give you examples where failure to assess one or two of those criteria has led to disappointing returns or kind of dead money. So basically, really quickly, what I'm looking for is an A team. So I think above everything else, you need to have the confidence that the team or founders that are running the company you're investing in are, via their CV or commercial history, or a direct conversation with them, which you'll do during due diligence, that you have to make your own assessment that this is an A team and this team can execute. That's number one. Number two is at least a B+ idea. An idea that has an above average chance of success. Personally, I prefer products and services that scale and produce recurring revenues. So as it scales up, it doesn't necessarily bring the cost base up, and so you've got a better chance of growth. Ideally, looking at a company that's past proof of concept, some historical figures, credible projections, sensible valuation, which I know we're going to come on to later, a clear capital plan, because you're going to give them your money. You need to know exactly where it's going to get spent and how internal returns will be made in that private company on the capital that you're proposing to put to work. That's very important. Mm-hmm. And then the next thing are more intangibles, really, and these have kind of gone up my importance list over the last 5 years, is transparency and integrity. And I'd still say today, most of my investments, transparency is lacking, communication to shareholders is lacking. So, if you're on a platform like Connected, for example, which is producing tools for whole cohorts of shareholders to be updated, I think that has a lot of value. In the private equity world, you have to be sure of the integrity of the people you're investing in. They have to be an A team, but they also have to have integrity. There are so many ways that as a minority private equity investor, you can be deprecated, marginalized, and your interests not aligned to the founders. Mm-hmm. So, reviewing the shareholders agreement, looking at the long-term exit plan, and as I say, this whole journey, if you can do that, and a lot of this is subjective, so my opinion will not be the same as your opinion. Is it an A team, B idea? Everybody will have a different view depending on their expertise in the underlying product and so on, which is why it's actually invaluable to embark upon this journey with others on a platform or in a private cohort, so you can bounce ideas off each other.
So on that, Neil, on the team and the communication between investor and investee, you obviously stressed the importance of it. I know that we as a team at Connected have a very good relationship with you. We know there's an open ticket to reach out to you if we need advice. You also quite like to heckle me on Strava, which is all fun and games, but it gets me down occasionally. But what does that look like for those listening right now who are perhaps going through the first journey of being an entrepreneur and thinking how they address investors? Is it something they should do weekly, monthly? Should they sort of get the feelers out there and find out what works for the investor? What's the best strategy there to optimize the relationship?
Yeah, I mean, I would say you have to get the compromise really between. As an entrepreneur, you're working, hopefully 24/7 to upscale your business. You every hour you're putting your whole self into this company, and it can be it can be use a lot of your time to raise capital and talk to investors. So I'm pretty sensitive to that. But I think it is reasonable to ask for monthly updates on, just on some skeleton metrics that shouldn't really take at all long to put together.
Yeah.
And then ad hoc communications if something's happening, like we've won this contract or we've got this problem. I quite like to be involved. Again, if you're in a cohort, and we can come on to this later, I've got a few of them where there's a shareholder representative who may have observer status on the board. Mm-hmm. So I'd say a little bit of salient information often means the shareholders feel more up to date, feel more loved, as it were. We're not asking for an annual report, so I would say kind of monthly light touch, and then maybe quarterly something a little bit more substantive.
Okay. So if we, I guess, sort of start at the initial process of viewing an opportunity, what does the first initial stage of the deal sourcing for you look like, and how have you done it historically versus how do you do it now, and what do you think sort of the future of it is?
Initially, when I started off in private equity, it was, as I say, I just met a couple of people at UBS, where I was at the time, who were private equity investors. And so the first two I made were word of mouth, and I hadn't really done this before. I'd been totally in the listed. And then I joined a platform, if I remember rightly. And then you get on email distribution lists, and via the private ones, I met some other people. I met a couple of guys at VCs. And so very quickly, I built up a kind of flow. And then you almost find because there's so many startups, which is why this conversation we're having today is very important, because you've got to shred the wheat from the chaff. Then you quite quickly get into the flow of deals. And one of the, I don't necessarily call it an error, but I'd say at the beginning, my criterion probably wasn't high enough, and I probably made a couple of investments that I shouldn't have made. I should have paced myself a little bit better, and I think I've got that balance now.
Yeah.
But yeah, I think it was through, in answer to your question, it's through formal platforms and through a privately built network.
Understood. And when that sort of like golden opportunity comes in front of you, or a opportunity, what are the first few things that you look at? I mean, I know personally that, like, I've always done this and probably always will do this. One of the first things that I actually look at is the team, which obviously you've touched on, which is trying to find an A-list team of people who have hit certain criteria in their sort of working history, or they worked at certain firms or whatever. Is that something that's shared with you, or what's the formula that goes through your mind to look to review an opportunity to get you excited enough to go to the next stage of even considering it or wanting a conversation with the founder?
I think what a lot of these opportunities come through the front page of someone's website or platform, or the title in an email. So first of all, what's the sector, what's the product, very quickly then determines whether you open the deck or not. So that's the hook.
Got it.
And as I said, I do like, I put it slightly overweight in software as a service type businesses. So then if it's something that I think I might like, I'll then open it and then look at, well, the two things concurrently. The A team, what have these guys done before? Mm-hmm. What are their CVs? What are they? Where are they expert? And then look at the idea. And if on my own, I think this there is a gap. This could scale. Then the next step is to discuss that with other people like me. I've got my own private network of two or three people around in the town I live here. Yeah. Then we go through it, and then express an interest, and then that stage you're then looking at having a conversation or a call with the CEO or the founders.
Okay, and then that conversation sort of kicks off. What does the process look like in terms of time frame, due diligence? Does the level of DD differ when you're getting involved with something that's very early stage to something that's a bit more mature? What kind of things do you look for there?
Yeah, so very early stage pre-revenue. I don't really do that anymore because it's a little bit of a crapshoot in that, you know, if you've got a team with no financial track record, even if on paper they are qualified, and there's no proof of concept or no lead customer, then you've got to be fairly wary. And I would only actually do that now if I felt that I really knew the space and the product. So I just me personally, it's all your own personal taste, but I don't go there now. I'm looking to happy to pay a slightly higher valuation for something that has a bit of proof behind it. You know, the concept is proof. Maybe they've got a lead customer. Maybe they've even got some, you know, contracts, some sales, and they can get an idea of what type of, you know, trajectory they're on. So all of that stuff will come up so you have an initial call with the CEO and the team, and then you probably follow it up. If you're still interested after that, you think it's a real go, and you look at you have one eye on the valuation, and then you come back and maybe look at more detail, you know, the financial projections and what underlies that. And then very quickly you can move to a point where, you know, you're going to part with the money.
Got it. Okay. I think like I just missed a small chunk out there, which is, so, you know, someone's approached you with an opportunity. What's in terms of collateral? Obviously, a pitch deck is very important, but, you know, perhaps you can share some thoughts on maybe what you think an optimal pitch deck looks like in terms of length. What are the key things and answers that the entrepreneurs should answer? Not necessarily the flow of information, but, you know, what are the key things that you think would, you know, is optimal for you?
Yeah, I mean, again, this is my opinion. You know, everyone is different. I don't like 25-page decks. You know, I don't think anybody's really got the patience to read all that. So you're really looking for a top page, which is boom, you know, exactly what it is, succinctly, what is the proposition, the team, and then historical financial information, use of funds. So you can see really in a couple of minutes the very high level schematic of what the investment is going to be. And then so maybe a couple of pages that maybe goes to more detail. The second page maybe go more detail in the product and the projections. And then maybe there's an appendix part which goes into competitor analysis and a little bit more tire kicking on the projections. So, but I'm pretty scared. And most people I talk to are, if you have a huge deck where the first 8 pages are just detailed technical stuff about the product, and you're weeding around looking for, well, what's the valuation? What are you doing? What's the capital plan? Then you can sometimes, you know, move on quite quickly. So
I mean, we at Connected see that a lot. You know, obviously we get sent decks all the time, and the ones that are the most stand out are often the simplest. That just tell a very easy to understand story. You know, there's a problem, there's a good team, there's a solution. This is this is the ask of the financials. This is how they're going to do it, and this is what the valuation is.
Exactly right. And you can always ask for more information. Yeah. So if you get through the first couple of pages, you're interested, you've assimilated the information in a matter of minutes, then you can determine whether or not you'd like to take that further. And then you can, normally if you're going to put a reasonable amount of money to work, you're going to have a face-to-face with the founders anyway, and you can just get them to take you through the detail.
On that sort of face-to-face, what's the perception across yourself and sort of the wider angel community you're part of with, you know, having sort of video calls? Is that something that's, you know, obviously COVID has sort of put a semi-blocker on, you know, people meeting face-to-face? Are you finding that sort of, you know, these kind of calls are useful? And, you know, would you feel confident in investing into a company having never physically met someone?
Yeah, I mean, this is great. You know, obviously the COVID thing has digitized the due diligence a bit, but yeah, I mean, it's always great. I mean, I'm an old guy, so meeting face to face is you can't really replace that. You know, you know, even walking to the door afterwards and chatting about stuff, you're always forming a view. Is this guy, you know, is this an A guy? You know, can he really? You get these kind of things you can't get over a video. Or over a call. But this is you know, it's, as far as substitutes go, it's perfectly adequate. You know, if you have a half an hour call with the founder, you go through it, and and I guess the advantage of a call is that you can get more people to the table via a call than you can, getting everybody to an office in London at 2 o'clock on a Wednesday afternoon, is a lot trickier. So from the company's point of view, I'm finding it's easier to put together a Zoom call than actually.
Yeah, for sure. I mean, from a founder's perspective as well, where you're, like you said before, working 24 hours a day, 7 days a week kind of thing, finding time, if you're based in somewhere semi-remote in the UK and you're trying to connect with an investor in London, historically, you would have to take a whole day out of your diary or half a day, whatever it is, to go down and meet someone and, potentially not get the success that you desired, in which cases it's, semi-weighted days. So I think, the usage of technology and being able to sort of have many of these conversations going on at the same time is super effective. And it's something that we're seeing to be very fruitful at Connected as well.
I mean, it's very hard yards for the entrepreneur. It's hard yards for them having multiple calls with multiple investors trying to scrabble together 20, 30,000 per ticket. And it's a big drain on their time. And a lot, and actually, I'd say most businesses that I've been involved with they actually get set back by the time used to raise capital. So being able to do things collectively is a big advantage. Both sides, actually. The company can do it raise capital more effectively. So via something like Connected, which you guys have set up, which is great. You can, if you're a member of that, then you can be alongside others who are like you in doing due diligence. And then also on the post-investment transparency and shareholder update. I know you guys are developing a tool for that. So, that works as well. So I think, digitizing and platformizing the act of due diligence investment and then transparency after and investment monitoring and portfolio management. I think this is the way forward and to do it. And, as an investor, it's always great to, my view of something will always be different to somebody else. I might be very enthusiastic about something. And then someone else goes, have you thought about that? Because I've seen something else that tried that and this went wrong. And then you think, I need to think about that. So again, there's a safety in numbers, aspect to it as well.
Agreed. And, that's something we were just talking about before. There's always an element of subjectivity with everything we're talking about right now. And if you can leverage off other people's resources and knowledge on a certain sector or something like that, then I think there's a really powerful opportunity there.
Yeah.
Just, I guess I'll bring it back to the opportunity. So we've, on a high level, gone over sort of deck. I guess sort of other collateral that might come into play is the need or want from an investor to see, a semi to fully robust financial model. To what extent is that something that an investor will want to see? You mentioned obviously sort of the use of funds. You would probably like to think that someone's not just done a sort of finger in the air and think, oh, we'll do 25% this, 25% that, 25%, and so on and so on. To what extent do you want to see some kind of financial planning in place? And also of that financial planning, how many months do you want to see sort of planned out in that model?
Yeah. Well, being an old guy again, I'm pretty cynical about financial plans because every one I've seen has never been met. So, and by their very nature, these high growth, high opportunity startups, it's almost impossible to forecast what's going to happen. But you do need a financial projection and you do need a capital plan. Where are you going to invest the money and what do you hope to gain from that investment? How are you going to grow the top line and so on? Yeah. So if we're past proof of concept and we've got a lead customer, and then in the deck, there's a proper plan as to who are the next customers, how big are they, what's the market share, what can we take, why is our product better than someone else's? And you put together sort of like a min and max assumption as to what you think you can take and what the costs of that will be. And you dovetail that into your capital plan. Have we got enough capital to support this? Where do we need to get for our next raise and so on? Then, so I'm really looking closer in actually, what's the next 6 to 18 months? you regularly get decks that go out 6 years with, in 6 years we're going to be billionaires, and we know that's that's not going to happen. Basically, maybe I'm just a bit too bitter and twisted, but
On that, then, if someone sent you like that, what would your perception be? Just
right. I mean, it does put you off when you see stratospheric projections.
Yeah.
Because you think, look, if something looks that good, it's not going to happen. Like, it's just the way I am, But I think you need to have, 6 maybe to 18 months out, a credible min max on your level of your sales and the funnel and the costs. And when you're raising money, again, always encourage companies to slightly over raise and may bank on the min rather than the max.
Yeah.
But I actually, what I quite like is a credible min. If a min that says, we might not sell anything for 6 months, we might have a dev problem, we might need to do this, that, whatever. Actually, I'm the kind of person who would actually, I'm more attracted to decks that actually show me the bad things as well as the good things, and then you can assess the risk reward. But a deck that just shows a hockey stick going to the moon, and everything's going to be great, sometimes you think, I've missed something here.
Yeah. I mean, we see those all the time, and I'll come on to that in a minute in terms of sort of valuations. But so on the sort of projections, at what point do you think that startup founders should start sort of readdressing their sort of existing investors and they're trying to raise more capital? At what point so let's say in a hypothetical situation, you raise enough money to keep in the bank to keep you alive for 6 months. Do you think that it's sensible to start sort of formulating new relationships or existing relationships with investors, 1 month out, 2 months out, 3 months out, or just keep the sort of relationship going constantly, which is is the tack that we take. We have a very good relationship with our investors, yourself being obviously one of them, and we're very transparent on sort of our projections and various other things. But as someone who's been very experienced sort of along the way and probably had lessons learned from opportunities, at what level would you get sort of annoyed with it? It's like, oh, well, I wish I knew this information earlier, kind of thing.
Yeah, I mean that Sam, that goes back to transparency, I'm saying. So if all being well, the company's making relatively regular updates to their investors, and again, all being well, your initial capital raise has funded some growth or some IP development. It could be both. Like the product has moved on nearer a launch if it's pre-revenue, or that actually we've got more customers and the MRR is increasing if it's post-revenue, or a mixture of the two. Mm-hmm. So if and again, from the founder's point of view, they need to be on the front foot with their investors as well, for the reasons you just said. You don't suddenly want to surprise them and say, I need money. Yeah. If you're the way it should work is that the company is making a good use of the capital it's been given. Profit is not necessarily something you should shoot for immediately, because you're still in the growth phase. Invest, grow your IP, grow your sales, and then the valuation is driven upwards. And most shareholders are very happy to, if they can see really good progress and things are happening, they're very happy to top up their holdings at a higher valuation. Yeah. You're always going to feel more comfortable if you've had the transparency. What a real turnoff is suddenly saying, oh, we need a raise, and it's a little bit of a surprise. Well, I didn't realize that we weren't making, we were about to run out of money, and if the business goes quiet and then comes and hopes to raise money, it's going to deprecate its chances of being able to raise money. So, the benefits of being transparent work both ways. And if things are going badly, and they sometimes do, if you've got some good shareholders, they can advise or help you out.
Absolutely. And you just mentioned a point there around profitability. Is profitability important for someone who's, someone might be watching this who might be very, very early stage and trying to launch something? Is that something that an entrepreneur should be worried about in the earlier stages? And if not, what would you say were the core 3 or 4 things that they should think about for the next 6 to 12 months, as an example?
Ordinarily, no. I mean, when you're scaling a business, immediate profitability. It's obviously nice if you're scaling and you've got some free cash flow as well, but that's very rare. What you really want to see as an investor is that the IRR, or the internal rate of return, the growth of the top line, the development of the IP, the potential of the business is enhanced by investing that money.
Yes.
If that means that they've got to come to the table for more cash, but they've successfully made those investments, then normally it's not a problem to put up a high valuation to reflect what's done and raise money. So I would say the most important thing is the progress of the business, its sales, its customers, and its IP. Early stage businesses are investing in their future, which means they're probably going to be loss making on a cash flow basis to start with. If they're not, it may mean they're not growing. If you look in the listed market, all the higher dividend paying stocks are not growing. They've got nothing better to do with their cash.
Yeah.
So I think driving just for profit very early is not necessarily the top thing.
Makes sense. And you sort of touched on sort of the hockey curve before. So one of the things that I've noticed over and over again, for the context of listeners, my role at Connected is to ultimately, I have a lot of outreach to startups. I'm very much startup facing person at the company, and I evaluate companies and basically take them to our investor base. Neil being one of them, and one of the major things that turns people off, investors off, is when founders come in with just astronomical valuations based off advice that someone who's not qualified to give advice has recommended. I've seen startups with sort of fag packet ideas valuing themselves at 20+ million pounds, with no IP or no customers or nothing. How much of that is a problem for you, Neil? How often do you see that, and do you have any sort of words of wisdom around valuation, and maybe some tricks and tips, or any sort of links or anything like that you can think of that you might refer people to?
Yeah, I mean, valuation is very subjective.
Of course, yeah.
And I have conversations with people. I know a couple of people starting who are 1 year into their business now, and they want to raise some external money, private equity money. And am I 1.5 million, or am I 3 million, or it's a little bit finger in the air.
Mm-hmm.
And the answer really depends. Is where can you get the investment? And the US approach is more kind of, well, I'll establish interest and then I'll set the price.
Yeah.
And if I need to raise 500k, get your interested investment and then talk about the price later. Here we're more kind of, oh, my pre-money valuation is 2 million. There are so many moving parts that to me really is a case-by-case basis. A really good entrepreneur who's got a great track record of building and growing and exiting companies can start a company with a new plan and immediately be on 5 million valuation or something because of the reputation.
Yeah.
Or someone could have hit something very good and have early traction, and you can see in the first 3 months of customer acquisition and cash flow that this is going to go. And again, the valuation goes a lot higher if you can see that. So I'm waffling a bit, but it's impossible to, like in the listed market, mature listed market, you've got PEG and cash flow and EBITDA multiples. They really don't apply to private equity. But I think, what you were saying earlier is right. If it's a great idea, but not a known entrepreneur, good qualifications, looks like he's okay, but no track record and pre sales, it's in the hundreds of thousands, and then you get to like a million and a half if you've got a lead customer and you've got a product. If you've got some kind of moat around the product, it maybe goes up a bit more. And then once you've got a growing revenue stream coming in, you may be in the 3-4 million, and then if it carries on from there, you go up, your valuation goes up, hockey stick as well. Yeah. But it's very, very judgmental.
Okay, I think we're just conscious of timing, so I think if we can sort of summarize, if I was to ask you the overarching question, which is, what does an angel investor look for in an opportunity? If you could summarize that up in 1 to 2 sentences, what do you think it might be?
Well, I think, as I say, it's definitely an A team coupled with a greater than B plus idea. Overlay that with some financial acumen and a realistic plan, and a sensible plan or track record in the use of capital, and then integrity and transparency on top of that. That's the meal I'm looking for.
Okay.
And there's enough out there that you should insist on having all of those things before you invest.
Yeah. One last question before we maybe reach out to some of the Q&A on the board is, if there's anyone watching this now who may be at a very, very early stage, at what point is too early to start addressing investors?
At what point is too early?
Yeah.
Well, the thing is, the earlier you address investors, the more of your company you give away. So if you're bootstrapping, if you're just starting yourself, I would say bootstrap it for a while. Try and get some of these things I've just alluded to done, because you know full well if you come to the investment community and you've just got a brainwave and nothing else,
Yeah.
You're probably going to get no investment, or someone might throw a tiny amount of money at you at a very low valuation, if they know you maybe. So my advice to a founder would be to, as expeditiously as possible, bootstrap it and get some things ticked off, and then you give away far less of your company when you bring in outside investors, and get your first lump of capital where you want to invest for real growth.
Excellent. Thank you very much for the answer. Francesco and Rahita, you guys still there?
Hi, Sam.
Hi. Should we open the floor up to some questions from anyone from the audience?
Absolutely. We have quite a few questions.
Excellent.
First, perfect. I think even Francesco is here. But I'd like to start off by thanking you and Neil for a very informative session. I can personally say that I've learned a lot from that. To start off, I would like to also just give a brief intro of just a Silicon Roundabout, just for all those who missed out and for the beginning as such. We at Silicon Roundabout are a deep tech. We are a deep tech, largest deep tech meetup fund in Europe, and we're also an upcoming fund as well. And I'd like to thank everyone who's come to the event today. So just to open up some questions to, this is us. I'd like to just in case any of you want to join us for future events, you can always log into our meetup, which has 14 plus members and counting. We have events like this. And we're always looking for the most disruptive startups in Europe. So please feel free to join our community and come to our events, and as well as log in with our startup profile. Now, I'd like to open the stage to some questions. As you can see, there are quite a few people who have a few questions. So the first one to start off with, Neil, is, do you have any advice in raising money for as a female founder? How do we increase the amount of money female founders are receiving in private equity? And this is from Amelia from the audience.
I mean, honestly, from speaking for myself, and I invested in a number of companies that do have female founders, and whatever your gender or race, color, creed, for me, makes absolutely no difference whatsoever, and it's all on the team and the idea. One or two of my most successful on paper investments are run by women, and I know the people that I in my investment cohort, close to where I live here, we would not, invest in anything because it had a woman at the helm, or vice versa. So for me, the basics are not that you're a woman, but you've got a great idea, you're qualified to move your business forward, and you've got a good team behind you. For me, you have an equal chance, in my eyes, of raising money as anybody else.
Yeah, I also echo that as well. And from a from a founder of a company that supports lots of startups, we work with many female founders. I also echo pretty much everything that Neil said in terms of, the capabilities of the team and the idea and all the foundations that Neil's just sort of laid, irrespective of gender, race, anything like that. It doesn't really matter. And I think some of the most successful companies that use it or are currently using Connected are female founders. We also have a strong network of female investors as well, who have been successful entrepreneurs who have exited businesses, or people like Neil who've had successful careers in sort of finance and law. So yeah, Amelia, if you'd like to connect, I'll be happy to have a chat with you.
Perfect. Well, thanks, Neil. Thanks, Sam. The next question is from Naveen from the audience. Oh, just as quick info for the others who have more questions, you can drop your questions down in the Q&A session and we'll be going through them live. So the next question is from Naveen, which is, how do you define an A team? Is it based on experience, academics, or are you open for looking at different profiles? I think Neil and Sam can take.
Yeah, all of the above, really. Again, it's subjective. If there is a commercial track record there, if there is a CV and an educational background or expertise there, all of those things, and plus a face-to-face meeting, and you can gain a lot from talking to someone about their investment idea, even if you're not an expert yourself. And you bring the whole thing forward, and then you make a judgment whether this person or this team is an A team or not. So it's not just qualifications. That's a bit rigid. If you can overlay that with some type of track record and other aspects to their background as well. Have they been a leader? Have they clearly, if they've done anything commercial before? If you're doing something in digital advertising, if you've been in media before, it helps. So it's the whole the whole thing really to determine whether it's an A team. I might think you're an A person, and someone else might think you're a B person. There's no formula for it.
Yeah.
I agree with that as well. I think there's something it's quite easy to identify someone who might have the X factor, and the X factor can be a variety of things. That they've maybe spun off from a large organization that has a notoriously hard recruitment process. They might have been held captaincies for regional or national sports teams or something like that. I think that the underlying thing that probably underpins it all is probably someone's attitude. Yeah. And also you have to be able to click as well. There's always do I like this person? If I'm parting with my own money, is this someone that I'm going to like and I back?
And the other, just to finish off that question, really important elements are, you could be superbly academic and knowledgeable on your product, but if you can't communicate and you don't know much about business, then it's going to fail. And again, I can allude to a couple of mistakes I've made in the past. If you could have a product expert, but they can't communicate what they're doing, and they have no idea about taking on money, investing it at a return, and driving their valuation. If you're too academic, for example, or too technical, you can get so absorbed in your product and trying to make it perfect that you've not got your other eye on, I've got to scale this business, I've got a budget, I've got to communicate with customers. So when I say an A team, I mean people that really cover all those bases.
No, I think that does make a lot of sense, especially given each startup provides different, each member brings different items to the team. And to follow up that question, there's another that is related to teams again from Sam from the audience. And he says that you speak about teams and what they've already achieved, what companies what companies you've previously worked for. What about first-time founders straight out of the university? Like, would that change your profile, how you view them as an investor, or would it come back again to the idea, and how big of a factor would that play for you?
Well, I mean, yeah, people straight out of university, I assume you're talking about a pre-revenue idea. So what you're likely alluding to there is a very highly educated academically excellent group of people, if there's a great idea attached to that, then everything has a price, and if it was a superb idea, had a niche, they had a great plan how to develop it, they costed it out, they thought about it, then it still can be very, very investable. But going back to an earlier question about when's the right time to go and get investment, what I would advise them to do is to try and get a few more things in the rearview mirror before attracting investment. So if you can build something on a shoestring or with grants or with family money first, then it will mean you give a lot less away of the equity at an uber low price. What you want to be doing is selling equity at a much higher price when you've achieved more. So, I mean, everything is investable. There's a price for everything. And, I invested in a really luxury high-end light bulb company with a bunch of graduates from Edinburgh University. And we've had a journey with them, but they are coming good now, and they're a decent-sized company with a new CEO. So, absolutely. But if you can get some things done first, do that.
Well, the next question we have is from Rajeshwari, and I think this goes back again to the decks itself or the approach that you send over to an investor. And her question was, do investors want to see the deck in the first email, or do you want to form a relationship with the founders first? And I think this is something that we've gotten quite a few questions given it's COVID. So how would you say one should approach you in such a situation?
I'd say an impactful, high-level communication, be it an email, be it something on a connected platform, where you can look at it and see immediately what it is. And then no harm in attaching the deck, because if you open, you can then read the deck. But I would always steer towards like an abridged deck, like a couple of pages, like teaser, elevator pitch. Everybody loves elevator pitches because they can hear them in like 1 minute. No one wants a 50-page deck. That said, there's no harm appending it. So if someone, okay, I've seen the idea, I've seen the headline, I can see the product, I see the team, fine. I look at the elevator pitch, great, I'm getting through it, I like it. And then if I then want to delve into the deck that's attached, I can. But at that stage, if I'm that far down the road, then I will probably need the founders and the owners to take me through some of the more detailed parts of the deck anyway. So I tend on keeping things clear and simple in the first communication, and just think about trying to get everything across in that first communication, be it an email or a platform post or whatever.
Yeah, I completely agree with that. So I think that, I'm someone who through our platform have seen potentially hundreds of messages from startup founders to investors. And going back to Neil's point of naturally academic people going sort of overkill on detail and almost writing a thesis to an investor, I think if you just take a step back and think about the life of an investor, they're either successful people who are still in a career, or they're managing lots of portfolios or whatever it might be. I think you really have to grab their attention. And the least successful ones I've seen are when people send like an essay with a deck attached. I think it's way more impactful to be like, hey Neil, I'm Sam. I recently we're a team of PhD whatevers from we recently spun off from this company or whatever. We're trying to solve X problem. Market size is Y. Like 2 or 3 bullet points on like key measures that we or key achievements to date, and then like would you welcome a conversation? Leave it at that, because the investor will see it, and all the key information to sort of trigger that first conversation will be there, and then it's down to the investor to decide whether they want to take it forward or not.
So there's a number of questions coming through on the Q&A. To try and buzz through a few of these.
Yeah, sorry, I'll probably.
How can entrepreneurs qualify invest in the same way as investors qualify opportunities? Right, so entrepreneurs, it's a two-way thing. Entrepreneurs, you're interviewing investors as well. You want investors who will bring value to the company. If you're if you're an entrepreneur, you want to sell the right amount of your company for a certain amount of money. You don't want to give away too much too soon. And what you should be looking for is to bring investors on who can add value to your business, not sleepy investors. So if you're in a certain product or sector, if you can get a shareholder that is expert in that sector to help you, then certainly do that. How do you ensure the integrity of investors?
Take that one offline.
Difficult one.
Take that one offline.
There's another one actually about how do you ensure the integrity of the entrepreneur. Again, I think that's through meeting, through ensuring that you've got your bases covered in the shareholders agreement. And again, it's not 100% guaranteed, but you've really, from talking about reporting and transparency and what they're going to do, and how often they're going to report to you, what they're going to do with the money, you've got to, and you've got a track record. I'd certainly research their track record.
There's a number of questions on here, and I'm happy to pick everything up offline, but I'm conscious of time. There's a couple of questions I've just spotted which you get asked a lot of, which is, does an angel, or would an angel be happy signing an NDA?
That's pretty normal, particularly if there's some IP involved.
Yeah.
So yes, there's nothing to be lost for me to sign an NDA.
I think that, again, with subjectivity, that answer, I think a lot of people just point blank refuse because
convertible loan notes, useful tool. If you want to keep your funding costs down, raise debt, and then not give away too much equity, and then if the convertible will normally convert into equity at a higher valuation, so that it can be a useful tool, normally for slightly larger companies. Do most investors active or passive? Two approaches. I prefer to be semi-active. In other words, I'm kind of involved. I can talk to the company. Passive implies that you kind of throw a small amount at a lot of companies. So again, it's personal preference there. The crowd cube type tend to be the passive types. I think
our stance there that we're connected though is we try and connect people on a strategic level.
Yeah. So if you're on a platform, you can be active via a cohort on something like Connected.
Yeah. So we will try and connect. Where there's alignment in things like professional background or industry background, or even where there's perhaps a lack of expertise. So perhaps someone's looking very specifically for a legal investor or an advisor. So again, subjective to what it is you're looking for.
Yeah. What's your view of health tech investing from Kevin Flanagan? Actually, 3 of my best companies are health tech. It's kind of in vogue now. It's connecting devices, patient records, and devices and so on together. You're right. The timeframes do take a while. The National Health Services are pretty difficult nut to crack. They have achieved good growth though. So it's what's your advice for health tech founders talking to angels? Well, it's the same advice as anything else really, is to have your case for how you're going to grow and what landscape you're going to grow in, and what aspect of health tech you're bringing to the table, which isn't covered already, or why you do it better than whether it's medical data or whether it's communications. Just be clear as to what your tech is offering that's better than what's already there, and hence how you're going to grow your business.
Neil, just one more question.
Yeah, I just wanted to say that Sam, I think we have to wrap up. Will have to be the last question, but everyone in the audience will take down your names, and you can. After the event, we'll share Sam's and Neil's details so that you can send the questions over to them.